Here's HBC on the day. This retailer, of course, well below its previous high of $30 a share. But because of the premium being offered relative to its recent share price on this go private bid, we are seeing a 44% jump in the stock today. There is an expectation because of the share ownership of Richard Baker and the other investors that this will be successful as they push to take this retailer private. It announced also the sale of European assets today. The move signals obviously continued hard times and changing times in the retail sector. Carl Boutet is chief strategist at Studio RX and an advisor to McGill School of Retail Management. Thanks for being with us.
Thanks for having me.
So, I mean, obviously retailers, especially these big box traditional department store retailers, have been struggling. Does HBC stand out in that regard? Is there anything about it that makes it different than some of the others that have similarly had the same kind of woes?
Maybe what helps them stand out a bit is their differentiation from the brands they have between Saks and the Bay. So it's not just a one brand story like we've seen in other markets, but they are still sort of stuck in the middle, which is where most of the damage is happening right now in retail. We can think about Sears here in Canada. So their positioning is a bit, is still a little bit too average, and that's, I think, much of the story that's happening here today.
One of the interesting things, of course, has been seeing the differentiation among retailers. Some of them do seem to be managing to hit it with investors and with consumers, more importantly, shoppers. Others don't. Obviously, we see the threat of the online players like Amazon and others, but why do some manage to do it while others like the Bay, and as you note, Sears, there are some others who really struggle? Why can't they all find a way to compete against these the online players?
I think it's cultural in a lot of these organizations. It's creating a sense of urgency where getting the team to buy in, the need to change. I'll send kudos to Macy's. I think they're starting to create this new climate of change, making acquisitions like the Story and Beta in a recent year, actually really looking to change the model. But the reality is they're stuck with these large footprints, very premium real estate, so they're very well located. But they're these big behemoths to a foregone past, really, that were at the time cutting edge, and now most of them are just really bland.
One of the things we've really noticed, of course, in HBC, with Richard Baker at the helm, because he understands real estate so well, it really has felt like a real estate play for the last few years in terms of asset sales, but also just some of the moves they made with the stores. Is that a smart play for them? Does that make sense?
In the context, yeah, I think most of the ones that have done well is because they've had a strong real estate portfolio and leveraged that. I mean, as much as Sears has been going through its struggles, Eddie Lampert seemed to have found a way to make money with the real estate. I believe Mr. Baker will probably be following a similar course. Their real estate really seems to be undervalued. If you look at their balance sheet, you'll see, the real estate's probably in the $4 billion range, and many think that the Fifth Avenue Saks store alone is worth more than that. So, hence a lot of the pressure that he's been under from his shareholders to get leverage more value from those assets. I think this is going to become a story where HBC is going to become really a real estate company, and probably will need to sell off more of its brands, as it tried to do with Lord & Taylor, and Mr. Baker is going to play to his strengths, which is really leveraging the real estate.
One of the reasons that they've cited for going private is to afford patience, that there will be time needed for the turnaround. Does that ring true to you, that taking it out of the spotlight of quarter by quarter reporting will be a good thing for this company?
Yeah, absolutely. There's a lot of retailers right now, I think they would like that. Nordstrom's recently tried to push in that direction. I don't believe they were able to raise enough private money to do it. But this quarter-to-quarter pressure for these large retailers is really unsustainable. I mean, the metrics are out of whack. Where they're being measured on same-store sales, and it's a lot of these irrelevant ways of measuring what retail was and not where retail is going, as the channels for finding revenue are way more diverse than what we reported in a same-store sales metric that the analysts tend to prefer. So taking it away, I think, is a very smart move. The reason he's doing that, I don't know if it's so much a patience as it is an opportunistic move. I mean, with the stock as low as it was, and again, looking at the balance sheet and the fact that the cash on hand kept on dwindling, the move to sell back to Signa, their European partner, for $1.5 billion. I mean, the timing is very good for the offer. I don't know if it's so much about patience, but maybe that plays into it. I'll be very curious to see what he actually does with the retail assets.
Of course, one of the things that Hudson's Bay, HBC, and some others have going is just their brand value, particularly Hudson's Bay, I mean, associated with the very formation of this country. How much value can they leverage off a brand like that, which still does have power, even if they, as you say, cash is dwindling, sales may be falling?
HBC, the longest running corporation in the Americas, it's 350th anniversary coming up next year. So there is definitely value there. And I think, let's not discount Saks. I mean, Saks still has, for a certain segment of the American market, a very prestigious, is still well seen. So, but HBC, personally, I think the play here is where they spin these off. These brands probably get downsized into a more manageable footprint where they can, for instance, with HBC, play more to the legacy of that fur trading, history. And there's a lot of great stuff in there. And there are some really great locations. Maybe they're too big. Look at what they did with, with Lord & Taylor on Fifth, using it as half of it, I believe, has gone into becoming a WeWork, which, by the way, WeWork is a big part of the investment group that Mr. Baker has. So it's interesting times in retail. I mean, the only thing that's, as we say, the only thing that's constant is change.
If you had to bet, based on the fact that the value of the retail portfolio may now be larger than the operating retail business, if you had to bet where this company is in 5 years, is it still an operating retailer or is it a real estate company?
Oh, I'd put money on the real estate piece. I think the retail part, I don't believe Mr. Baker. I mean, he has some he's attracted really good talent. The executives that he's had on board have all proven themselves in the market, but I don't know if he's really in it for the retail. I think the retail helps him increase the value of his real estate portfolio. But I don't really think he's a retailer. I don't think he's ever been, and probably not that interested in how messy this is all becoming. So, but it's all going to be about how does he leverage the value, and what is somebody prepared to pay for it?
Carl, thanks for your thoughts today.
Thank you, Amanda.
Carl Boutet is Chief Strategist at Studio RX and an advisor to McGill School of Retail Management.